At this point in earnings season, what are your key takeaways?
I think so far it's been a very interesting earnings season, and I can say that now that we're sort of around the peak of the season as we're proceeding. Takeaway number one is I think there was a very high bar set for companies that seem to be beneficiaries of tax or regulatory reform. And the reason for that would be we really heard nothing but good news. You had a good economy, and people's expectations sometimes get a little bit carried away, especially if the companies don't tamp them down. And we didn't have a ton of pre-releases or warnings this time, so people. Investors can sort of say, well, things are good, things are even going to get better. There's all these tailwinds behind an individual stock, and so we haven't heard anything bad. So let's think the best. And you know what? That becomes a very high hurdle to beat. And earnings season is all about beating the expectations, not necessarily what the absolute number is. You can be up 15%, but if the market expects you up 20, too bad. And the flip side would be, the market, if the market's expecting nothing and you give them a couple of percent, the market may love it. So it's not necessarily an absolute, it's really a relative to expectations effect. And what we saw was many companies, many big blue chips, come out with seemingly good numbers and say something either in the guidance, such as Caterpillar, which got off to a very fast start after they released earnings, and then closed sharply lower because during the conference call, basically they alluded to the fact that this might be the best it gets. And so again, markets are forward-looking. So there's so many moving parts, and there was so much good news built into so many large industrial companies and multinationals. Another reason possibly for some of the underperformance of the multinationals is, in many cases, year over year, you had very favorable currency translations. Most of these the multinationals by definition, and most big U.S. companies are exporters. And so what would happen would be, if you have a weaker dollar, that helps your bottom line. The problem with that is that's fairly transitory. Companies tend to blame a stronger dollar when they miss their number. They don't necessarily tend to credit the weaker dollar so much when it benefits them. It's human nature. Why would I benefit? Why would I acknowledge that it's an external factor when I could just say it's my own prowess? That's cynical, but possibly true. But that definitely, I think that certain situations there were times when investors read through the numbers and said, well, some of this growth may be just due to favorable currency considerations, and there's no guarantee that continues. We'd like to see more organic growth. On the flip side of the bar being set too high, you actually in many cases had, not many, but in some cases had companies set a low bar, or the market set a low bar for the companies, and then they beat them. Two examples come to mind there, one being Facebook, which had sold off on a barrage of bad news. I'm not going to go into it all here. But most of that bad news was actually very late in the quarter, and some of it in the second quarter. So as a result, their numbers were excellent. Meanwhile, you had all kinds of people selling on the gloomy stories coming out about data mining and things of that nature. And so as a result, I think you had a bit of seller's remorse after Facebook, and the stock rallied. Part of it, the rally was probably a bit accelerated because so many people had sold out in advance of it. It has been a high flyer. It's been a big winner for so many people for so long. They probably sold it reluctantly and then had a bit of remorse when they did so because the numbers came out so strong. Another example is Chipotle. That stock was up in double-digit percentage terms after earnings. It's been a perennial underperformer, pretty much starting with the food poisoning problems they had a few years ago, but it never really recovered from that. I think the psychology on the stock changed. Along the way, they changed leadership. They were able to put in a set of numbers that beat, gave some fairly rosy guidance, and I think you had a bunch of people who had been shorting the stock being forced to cover. One thing to keep in mind here is market reaction on the short side can be very dramatic when you have a short squeeze. Why? All shorts are done on margin. Not all longs are done on margin. You have I would say the bulk of stock is owned by cash accounts. Certainly nonprofits and things like that are not, index funds are not heavily levered. But yet every short sale is a margin trade. So faced with a margin issue, short sellers tend to be a bit more skittish. And that's why you'd see great results in that situation. Great market performance in that situation, I should say. Earnings do often tend to be asymmetrical. Companies tend not to go up as much as they go down. They get punished when they miss. We've seen plenty of it, but I wouldn't say we've seen an abnormal amount of real punishment. We've seen a lot more of malaise and minor disappointment when companies have been, let's say, beating or not beating by big margins, where the market had kind of gotten a bit of ahead of itself in expectations. So let's see where the rest of the earnings season takes it. I think people may have tempered some of their expectations a little bit, which is why you've seen some down days mixed in with some up days over the last few weeks. And as that comes into play, we'll see where the rest of the season takes us.